Good afternoon to you, ladies and gentlemen. It is time for this week's Housing and Economic Market Pulse update, where we're going to review what happened last week. We're watching those inverted yield curves, and we're going to give you this week's national market housing update. I'm going to give you the no BS data of what is really going on in the national housing market, so make sure you're tuned in for that. As well as I'm going to start doing our local market update in Southern Nevada in a separate video to make these videos shorter and more condensed. I'm also going to give you the predictions for this week, and we are also watching what the Fed is doing with our Federal Reserve policy forecast. It's October 31st, 2022. Happy Halloween. Thank you for being here. If you're out with friends and family tonight, please be safe, enjoy, and have a good time. Let's begin with our review of last week. The bear market rally rocked on as the three major stock indexes surged again for the week, fired by investor expectations that the Fed would shift to smaller rate hikes after this week's meeting on November 2nd. However, it was not all copacetic as core PCE inflation, it did rise in September. Consumer confidence fell thanks to rising food and gas prices, which continues, and corporate earnings from some big tech companies disappointed. A key inflation gauge for the Fed, which is the PCE, rose half a percentage point in September. That was in line with expectations. Including food and energy, PCE inflation rose 0.3% for the month and 6.2% on a yearly basis, and personal spending rose 0.6%, which was more than expected amid the rise in prices. However, increased consumer spending on credit is rising. Compensation costs increased 1.2% in the third quarter, and that also was along the lines with the estimates. But a bunch of blue chip companies delivered good Q3 earnings and guidance, and personal income and consumer spending edged up, and the initial quarter 3 GDP read showed moderate 2.6% growth after two straight quarters of contraction. This was better than expected, with the estimate coming in at 2.3% as growth turned positive. Now, take these reports for what you will. I'm sure it will be revised. We have an election coming up in 9 days. They need as much good news as possible to try to hold power, so do not be shocked if this gets revised downwards very, very shortly after the election. Now, a narrowing trade deficit and increases in consumer spending and government outlays did boost this number, so they say. A sharp pullback in housing subtracted from the number, part of a broader decline in private investment. Consumer spending decelerated, increasing at just a 1.4% pace in the quarter. That's down 2% in quarter 2. The week ended up with the Dow up 5.7%. The S&P 500 up 4%, and the NASDAQ up 2.2%. And anticipating a Fed slowdown in rate hikes, bonds also soared. The 30-year UMBS 5.5% up 1.76 to $99.03. But nevertheless, the national average 30-year fixed mortgage rate gained 14 basis points, which is 0.14 of a percentage in Freddie Mac's primary mortgage market survey. And remember, guys, mortgage rates can be extremely volatile, so check with your mortgage professional for up-to-the-date minute information. Now, we have been watching the inverted yield curves for quite some time. The 30, 10, 5, and 2 were actually all down from last week's reading, and the 2-year Treasury bond yield remains inverted with the 30, 10, and 5. 30-year Treasury yield is currently sitting at 4.196%. The 10-year, which closely follows mortgage rates, is down from 4.215% to 4.073%. The 5-year at 4.248%. And the 2-year at 4.499%. That's only down fractionally because last week's reading was 4.503%. All right, so moving on into our national housing market update. First, we'll start with new homes and then go on pending home sales. New home sales fell 10.9% in September and are now 17.6% below where they were 1 year ago. Now, with rising mortgage rates and higher prices, the problem is declining affordability for new construction. The median price of new homes are up 13.9% from 1 year ago. Now, the pending home sales index of signed contracts on existing homes dropped 10.2% in September for the fourth straight month. The National Association of Realtors observed persistent inflation has proved quite harmful to the housing market, and you guys all know that Fed Chairman Powell said a couple months ago that housing needs a reset. This may be their way to do that. The median sales price of existing homes in the United States, which was last updated October 20th, 2021 for the month of September, dipped down to $384,800. That's down from the June peak of $413,800, and that's a decline or a decrease of 7.01% since the June peak. So median prices have come down 7% from June to September. We will get you guys the October numbers as soon as they come in. Month over month, contract signings pulled back in all four major U.S. regions, and pending sales decreased in all regions compared to 1 year ago. However, for resale residential properties, affordability is improving. For the second month in a row, the Case-Shiller and FHFA home price indexes fell in August, hitting the fastest pace since 2010 to 2011. And they're still up annually. Case-Shiller up 13% and FHFA up 11.9%. This means with prices coming down to compensate for the higher rates, we should see affordability start to rise if mortgage rates can remain stable. Little did you know, I thought this was very interesting. So home buyers who are seeking rate relief are turning to adjustable rate mortgages, ARMs, to reduce their monthly mortgage payments. ARMs accounted for 12.8% of all mortgage applications last week. That is a 14-year high. We're also seeing a 2-1 rate buy down, which means lenders will give you a mortgage rate which is 2% lower for the first year and then 1% lower for the second year. And then at the third year, they're going to go to market rates, or you can refi if you're betting that rates will come down in that time. So people are turning to this as an option to lower their monthly mortgage payments by several hundreds of dollars. Now, are you preparing for the opportunities that will arise in this downturn real estate market? We laid out the entire playbook for you to start to prepare for an opportunity that only happens once about every 10 to 20 years, 15 to 20 years actually. And I want you guys to get that. So go to my Substack, jordandove.substack.com, enter your email address, read the latest article after the market updates post. It'll be the real estate playbook, how to prepare yourself to make financial freedom in a downturn market and create wealth. I don't want you to miss that. It's a great opportunity. I lay out how to prepare for it and exactly what to do. So go check that out. Now, I usually get into the local market update here for Southern Nevada. I'm going to start doing a separate video on our Southern Nevada market update, which I believe will start coming out every Tuesday or later on Monday evening. I have not decided yet, but I wanted to shorten these national market updates for you. So make sure you subscribe so you can stay up to the date on all the market information. Las Vegas is a huge market, and it's an important indicator of where housing may be going in the future. So I think it's a really good market to look at in terms of what's going up, what's going down, and looking at the data. Now, let's move into this week's forecast, and we are forecasting that construction spending, manufacturing, service jobs, the Fed, all coming out this week. This week has everything, and construction spending is expected to be off a bit for September, but we'll watch the residential number. The ISM manufacturing and non-manufacturing indexes are forecast to drop, but still show expansion, and manufacturing will show just a very little bit of expansion, if not a contraction. Non-farm payrolls from October may slip, and the Fed's FOMAC rate decision should be another big rate hike on Wednesday. And speaking of the Federal Reserve, and to finish off today's episode on the Market Pulse, we are forecasting Federal Reserve policy for the coming months, and Wall Street now expects and has expected a 0.75% rate hike on Wednesday, but then 0.5% rate hikes in December and February. Wall Street currently has a consensus of 79% for a 75 basis point rate hike, followed by a 91% consensus for a 0.5 point rate hike in December at the December 15th FOMAC meeting, and a 61.9% consensus for a rate hike of another 0.5% at the February 1st FOMAC meeting. The November 2nd FOMAC meeting begins tomorrow and will conclude on Wednesday, so we should, as we anticipate, another 75 basis point rate hike. There is talks of the Fed starting to pivot and start to lower rates, and then I think we'll become more stable. I think mortgage rates are going to remain elevated between 7 and 8% for quite some time as prices start to come down to meet affordability with those rates, and then prices still come down. Rates eventually will start coming down with those prices that have been reduced, and you're going to find a nice sweet spot there. So make sure you get the playbook, because that's when you're going to want to jump in and take the opportunities and be lowballing on those offers. So go to jordandove.substack.com to get those. Hope everyone's doing well. That's it. I was able to cut off 5-6 minutes by not going into the Southern Nevada market update. So subscribe so you get all the updates. Leave a comment. Let me know what you guys think. What is the housing market going to do? Where is it going to bottom for a national median? Let me know what you guys think. As always, you can visit my website, jordandove.com, to get tons of articles on the market. I hope everyone's doing well. Please take care. Have a very happy Halloween. If you're dressing up, let me know what you're dressing up as. I am going to go off the cuff here, and I'm going to dress up as a real estate agent and put on my nice Hugo Boss suits. All right, you guys take care. Have a good one.